this presentation on option basics. I am the presenter Aninda Datta. We'll briefly cover the mentioned topics about option in this presentation, like derivatives and options, broad definition, types of options, components, styles, types of contracts, risks, and basic strategies in options. What is a derivative? It is an instrument whose value depends on value of an underlying security or asset or commodity. Broadly, there are two kinds of derivatives, futures and options. In this presentation, we'll cover various aspects of option. A question crosses the mind of all prospective investors is, what are the benefits of investing through options or derivatives rather than investing directly in the security or the asset? So the various benefits of investing through options are listed here. Like the investor has to invest much lower amount, or he can choose his delta, the quantum of risk could be chosen, or one can generate regular income by selling options, etc. There are two kinds of options, call and put. A call option gives the right to buy an asset at a predetermined price, whereas a put option gives the right to sell at a predetermined price on a future date. That's what is mentioned here, and examples are also mentioned in the slide. Based on exercise date, options are of three kinds: European, American, and Bermudan. But only European options are traded in Indian exchanges like NSE and MCX. Now, based on relative gap between the strike price and the spot price, options are categorized into three varieties: at the money options, in the money options, and out of money options. The details of each type are given in the slide. Also, the example of each type is mentioned in the slide. As an option price has two components, time value and intrinsic value. But out of money option has no intrinsic value, it has only time value. Whereas in the money options and at the money options have both time value and intrinsic value. Now, risks and benefits of buying and selling call and put options are mentioned in the slide. On buying an option, the potential maximum loss is limited to the premium paid, whereas on selling an option, the maximum potential loss cannot be quantified beforehand. But the time value always works in favor of the option sellers and against the option buyers. There are two main option valuation methods: Black-Scholes method and binomial method. But Black-Scholes method is a more widely used and prevalent method used. The exchanges display in implied volatility of an option based on the based on the Black-Scholes method of valuation. The Black-Scholes method equation is mentioned over here. All the variables affecting the final price are also mentioned here, like spot price, strike price, time to expiry, etc. And the ND1 is the cumulative distribution of D1, and ND2 is the cumulative distribution of D2, assuming that the returns follow a normal distribution. Now, option Greeks. Option Greeks are the terminologies used to mention the key metrics of option valuation. Here, implied volatility is the most important metric which is deployed in the option chain of the which is displayed in the option chain of the exchanges. It indicates how expensive is an option, considering a specific strike price and time to expiry. The individual Greeks are mentioned in the subsequent slides. Delta and of call and put options are displayed on the slide. Here, specific volatility and time to expiry and risk-free returns have been considered, and the graphs show the relationship between stock price or the price of the underlying with the delta for both call and put. Now, delta is the first order derivative of the option price with respect to spot price of the underlying asset. Some characteristics of delta are mentioned in the slide. Thetas of call and put options are displayed on the graph. Here, the relationship between theta and stock price is shown assuming a specific volatility and rate of interest and time to expiry. Theta is the rate of change of the option price with the passage of the time. So it is always negative. As option price reduces with time, provided with other factors remaining constant, so theta is always negative. The following this slide shows the gamma of call and put options for specific strike price and a specific time to expiry. It shows the relationship of gamma with the stock price. Gamma is the rate of change of delta with the change in spot price of the underlying asset. Gamma is same for both call and put option for a specific spot price of the underlying asset. The slide shows Vega of call and put options. Now, Vega is the change in option price with respect to change in volatility of the underlying asset. Vega is also same for both call and put option for a specific spot price and a specific volatility. This slide shows the various option strategies that could be adapted profitably under various market conditions. However, these strategies are not rigid, and generally in a real life situation, a combination of these strategies are adapted in a specific marketplace. So thank you for watching this video and this presentation. Have a good day.